Before Warren Buffett became one of the richest men who ever lived, he made a choice that could have wiped him out. He was already wealthy, respected, safe. Next, he put a massive wager on a faltering American economy while the rest of the world was running for cover. If he was wrong, decades of discipline would be gone in months. If he is right, then he will have proved that fear is the greatest opportunity money can buy. This is not just a story of a billionaire. This is the blueprint of how one mind learned to think differently from almost everyone else. Omaha, Nebraska, far from Wall Street, far from glamour. But numbers fascinated him early. At the age of 6, he bought Coca-Cola in six-packs. Then he resold the Coke bottles individually for a profit. At the age of 11, he bought his first stock. At the age of 13, he filed his first income tax return, not for necessity, for curiosity. His father was a stockbroker and then a member of Congress, but wealth is no guarantee. Buffett saw the markets rise and fall during the Great Depression. He learned about fear and the destruction it can cause. These early observations instilled in him a question that remained lodged in his brain. Why do people panic when logic says wait? He wasn't looking to make money for status. He was studying. And human behavior, he realized, moved markets far more than math ever could. A turning point was reached when he read Benjamin Graham's The Intelligent Investor. One thing Graham believed: stocks aren't tickers. Stocks are parts of a business. Buffett did not merely read the book, he lived by it. After studying under Benjamin Graham at Columbia University, Buffett had a choice: stay in New York, follow the traditional route, safe job opportunities in established companies. Instead, he went back to Omaha, financially invisible, geopolitically irrelevant, and certainly not a financial elite member. There, he started managing funds through small partnerships, friends, family, anyone who would trust a young man with unorthodox ideas. He pledged discipline, not miracles. He looked for undervalued companies, that is, companies that were selling for less than they were actually worth. It was slow. It was unpopular. Had he inaccurately analyzed the situation, he would have lost not just money, but also trust. And the only currency he had at the time was trust. Markets were volatile in the 1950s and early 60s. Every time the market went down, his commitment was tested. People doubted him. There were no opportunities available. Cheap stocks were not necessarily good stocks. Yet, Buffett stuck to the process, buying value, requiring a margin of safety, and patiently waiting. The risk, however, wasn't just financial. It was a psychological thing, choosing patience in a system addicted to action. The company that shook up everything did not look very impressive. It was a failing textile manufacturer named Berkshire Hathaway. The American textile industry was dying, mills were closing, and overseas competition was crushing margins. Most of the investors experienced a decline. Buffett saw cash flow. He purchased undervalued shares, believing he could extract value, and eventually took control of the company. The textile business continued to struggle, but Buffett made a critical shift. He made Berkshire Hathaway an investment vehicle. Rather than investing to save a dying industry, he leveraged the company's capital to acquire pieces of harder businesses, insurance companies, banks, consumer brands. One of the most important insights came from insurance. Insurance companies collect premiums today and pay claims later. That float, money held before payouts, could be invested. Buffett realized this was low-cost leverage if managed carefully. Whereas others leveraged banks, he deployed insurance floats, compounding returns over decades. He stopped buying just cheap companies and began buying great companies at fair prices. Businesses with strong brands, pricing power, and loyal customers. Coca-Cola, American Express, Apple later. Simple products, durable demand, predictable cash flow. He didn't sell and buy, he invested. Buffett's story is not a straight line upward. In the 1960s, he liquidated his original partnerships because he could not find enough undervalued opportunities. What happened is that sitting on cash while other people are making fast gains made him look outdated. Critics said during the late 1990s tech boom that he had lost his edge. He avoided most internet stocks, labeling many of them speculative. He was ridiculed because of not knowing the future. Then, the dot-com bubble burst.
billions disappeared from companies without profits. Buffett's restraint suddenly looked like foresight. But even he erred. He invested in Dexter Shoe, paying with Berkshire stock, shares that would later become worth billions. The shoe business failed. The opportunity cost was huge. He held on to certain investments too long, missed others entirely, including early opportunities in companies like Google. He said his biggest mistakes are usually the opportunities that he has not taken. The hidden truth is that Buffett does not avoid making mistakes. No, it's that he survives them. Conceived in such a way, his system cannot allow one failure to destroy the whole structure.
Berkshire Hathaway was no longer just an investment firm by the 2000s. It was an empire of operating businesses. Railroads transporting American freight over vast areas, energy companies powering cities, producers of parts for industrial products that most consumers will never see, retail brands at home. Each purchase brought in stable earnings, which were then used to purchase still more companies. The cycle repeated itself. Buffett was not one to rely on heavy use of debt to gain a competitive edge. He lived by the strategy. Mr. Buffett came in during the 2008 crisis, when markets were losing money and banks were in trouble. He invested billions of dollars in companies like Goldman Sachs and General Electric at very favorable terms, preferred stocks, high interest, and stock warrants. While others feared total collapse, he saw a temporary panic. His calm became capital. The same was true in other downturns. When liquidity disappeared, Berkshire supplied liquidity at a price. His empire was built not only in bull markets, but also in the midst of maximum uncertainty. Buffett did neither create new technology nor found any Silicon Valley giant. His influence was philosophical. He showed that long-term investing is more profitable than trading. He made shareholder letters annual required reading at business schools, using simple language with deep insight into finance. He also redefined the concept of wealth responsibility.
In 2006, he committed to devote the vast majority of his fortune to philanthropy, mainly through the Bill and Melinda Gates Foundation. This was not a move undertaken by him in his old age. This action redefined the way other billionaires perceived legacy. The Giving Pledge, which was partly inspired by Buffett, asked the ultra-wealthy to pledge the majority of their riches towards charitable causes. Yet his success also reflects broader economic circumstances. The shareholders reaped the benefit of compounding over the years. In some acquired industries, workers faced restructuring and efficiency pressures. This type of capital allocation on such a massive scale affects jobs, communities, and industries as a whole. His decisions reverberate beyond the stock markets. Lessons and wealth principles. 1. Patience is a financial weapon. The majority of investors fail not because of ignorance, they fail because of impatience. 2. Buy businesses, not hype. If you're not clear about how a company makes its money, you're speculating, not investing. 3. Demand a margin of safety. Leave room for error. Optimism without protection is risk disguised as confidence. 4. Emotions influence markets more than logic does. Fear breeds discounts. Euphoria breeds bubbles. 5. Compounding requires time and discipline. Small advantages add up to extraordinary results when consistently applied. 6. Reputation is capital. Trust enabled Buffett to conclude deals that others were not able to, particularly during times of crisis. Warren Buffett is presently in his 90s. The world he mastered is changing. Faster technology cycles, algorithmic trading, global instability. He has designated successors. He has established systems. Berkshire Hathaway is a company designed to last beyond him. But one question lingers. Will a philosophy of patience, simplicity, and human judgment succeed in an increasingly fast and automated market? Because the true story of Warren Buffett isn't just about how he accumulated his wealth. Rather, the question is whether the thinking behind it will survive the man who has demonstrated its efficacy.